Hi there, welcome to GrainTV. It's Wednesday, October 28th. We had a down day in the grains. Let's take a look at the grain hedge trading platform to see where we closed. In Chicago, corn closed down 4 cents a bushel at $3.76, while beans took it on the chin with a 9 3/4 cent loss, closing at $8.81.5, while wheat in Chicago off 2 1/4. News today was mostly non-existent. We did have some discussion about beans, and in particular the improving planting conditions in South America, where rains are returning to areas where they need it and slowing down in some areas where they don't need as much. So overall, there just wasn't much there to give this bean market anything but downside pressure. We've had 2 days in a row without any new sales to China. Last week, that was a prominent feature that helped at least stabilize or support the market, but today and yesterday we've had no new news on Chinese demand, so that's really sort of been left the market to turn to just simply a supply side rhetoric, which is mostly negative right now. Let's take a look at the daily bean chart, and we're going to focus here on Jan beans because Friday is first notice day on November, so make sure you're out of positions by close of trade tomorrow. Let's take a look at the long-term downtrend here. We've got two downtrend lines drawn off of the highs from last summer. The smaller or lower line, you can see channels down to 860, and that was our sort of overhead resistance until about a month ago, and then we bounced above that and have been trading down since. So this is sort of a channel wedge that's developing right now and leading the market to lower prices. Look for this potentially to go down and test the lows in that 860 range on January beans. Let's take a look at some of the other news that came out today. In the outside markets, crude oil got a nice rally on some somewhat surprising EIA data. Inventories of crude were a little lower than what had been expected, but the real surprise in crude was the reduction in gasoline inventories, and so that was somewhat supportive to crude oil. We saw a nice $2 a barrel rally as a result of that news. The other news that came out today that was influencing outside markets was the Fed announced their policy stance. They continue to hold interest rates steady, but they are seeing more growth in the U.S. economy, and they essentially noted that housing expenditures and business investment were both positive, somewhat offsetting the slower jobs growth and the outside global influences of China being weaker. So that led the market a little down as a result of that announcement, with traders starting to factor in higher interest rates. In the corn market, the EIA also announced their latest ethanol production, and that was a little disappointing for corn because we saw a reduction from last week's production off 7,000 barrels a day to 944,000 barrels. This is at a time of the year where we usually see production really start to ramp up, and we are outpacing last year by about 4%. But again, it's not a significant increase that we would like to see at this time of year at the height of harvest. So, there's two factors here. One, sort of the lower margins in the ethanol business, and two, the tight supplies that farmers are holding on to in terms of corn production. So all of those are probably contributing to somewhat of a weaker ethanol production right now. Let's switch gears and talk a little bit about trading strategies. We've been talking to clients at Grain Hedge about their post-harvest marketing decisions. We have people that have been long in these 420 puts for quite some time back to the summer, and we're seeing those puts getting about 3 weeks away from expiration. Those 420 puts have some nice value in them right now, closing about 44 cents in premium. What we've been talking to clients about is rolling those options, capturing that value in that put option and taking additional price protection in, say, an extended contract of March at a lower strike of 370. So if you do the math here, what you're basically doing is liquidating an asset that's worth 44 cents, recapitalizing it in a 370 put that only costs you 10 cents. So in essence, you're pocketing that 34 cent difference. This is a nice strategy because it pockets the pockets the money that you've made on that put, locks it away, but still gives you downside price protection. We've been talking about the weak export picture for corn. That leads me a little nervous about the potential for a big rally here in the next couple of months. So having that put in place for March delivery gives you more time horizon, gives you more protection, and at the same time, by cashing in that higher priced put option, you're capturing that value. If you have any questions about trading or want to take a trading demo of our platform, by all means, visit us at grainhedge.com or give us a call, 877-472-4607. We'll see you tomorrow when we'll be talking about USDA's latest export sales report. Have a great day.